Hello, everyone. Thanks for joining for our Stream investor presentation. My name is Phong Le. I'm the President and CEO of Strategy, and I'm joined by our Executive Chairman, Michael Saylor. I'll quickly walk through the high-level term sheet for Stream. This is an SEC-registered security priced at €100 per share of Stream. This will be senior to two of our other preferreds, STRE, and MSTR common stock, and junior to our other two preferreds, STRE, and our convertible debt. Stream is perpetual and will pay at a dividend rate of 10% per annum. There are other dividend stoppers, dividend deferrability, liquidation preference details that you can see here. We plan on offering this and listing it on the Euro-MTF exchange in Luxembourg. So let me start with an overview of the company. Strategy is the first and largest Bitcoin treasury company in the world. We have 641,205 Bitcoin, which is 3.1% of all Bitcoin that will ever be in existence. Our market cap's currently at around $77 billion, which makes us the 138th largest publicly listed company in the United States. And this year alone, we launched 4 preferreds in the US, Strife, Strike, Stride, and Stretch. And our most recent one, Stretch, STRC, is the largest IPO so far in the US in 2025 at $2.5 billion. In year to date, we've raised nearly $20 billion of capital. And those proceeds have been used to buy Bitcoin. And it's about 88% of what we raised in 2024. And we have a couple months left to go this year. Every single quarter since we launched our Bitcoin treasury company strategy in Q3 2020, we bought Bitcoin, 85 acquisitions total. And we intend to continue buying Bitcoin into perpetuity. Those Bitcoin purchases have positioned us as the 5th largest treasury in the US, compared to companies like NVIDIA, Amazon, Google, Microsoft. And we expect that in about a year, we may be the 2nd largest corporate treasury in the US. And our objective is in about 5 years to be the largest, larger than Berkshire Hathaway, larger than the Mag 7. Our strategy has been very successful. Since the beginning of our Bitcoin treasury company strategy, August 10th, 2020, we've seen 80% annualized return on MSTR, making us one of the top performing equities in the US. And more interestingly, our performance has outstripped that of Bitcoin by nearly 2x, which has been nearly 2x the performance of the Mag 7, which has been nearly 2x the performance of S&P 500. As you look at the rest of the asset classes here, we've outperformed bonds by essentially infinity. Our access to the capital markets has been quite robust. I mentioned we've raised $19.8 billion so far this year. We raised $22.6 billion last year. What you'll see, last year we were primarily focused on convertible debt as our primary leverage instrument. This year we've decreased our reliance on convertible debt, and we really amplified our securities by investing in Bitcoin through raising of capital through our preferred, $6 billion so far. And that's going to be our primary way that we raise capital on a go-forward basis. So what are we? We're a company that issues Bitcoin-backed securities, right? And for those who want access to Bitcoin with 50% return, 50% vol, they can buy the underlying Bitcoin. What we've done with MSTR is through leverage and through amplification, create a higher volatility and higher returns, 80% return, 70% volatility. And that's been very successful for us, as you've seen, with the increase in our equity value. But what we found is some investors don't want more volatility and more returns than Bitcoin. They want access to Bitcoin, but they want lower volatility, lower returns, and better downside risk. And that's why we launched the preferreds this year, 4 preferreds. The first one was Strike, which is about $1 billion in market value at this point in time, and 30% vol, 9% yield. And you'll see we found instruments, Stride, Strife, Stretch, that have reduced the volatility profile. And so similar to an oil refinery, or an oil company that refines oil and creates products like kerosene, gasoline, jet fuel, asphalt, lycra, spandex. Strategy refines oil, refines Bitcoin, and creates Bitcoin-backed securities. And what that's done for us is the preferreds that we've issued because of their unique nature, because they're backed by Bitcoin, because they give access to Bitcoin with different profiles. They've been extremely liquid and extremely accessible in the U.S. market, trading on the Nasdaq. Right, you'll see here that Strife, Strike, Stride trade on a daily basis, about anywhere between $13 and $18 million a day. Stretch has been extremely successful and has traded about $72 million a day. That's 72x the average US dollar listed preferred. And if you look at the average Euro hybrid, it's about that much more liquid too, 72x. And a non-listed prefers in the US is significantly more liquid, 720 times more liquid. And so we expect that as Stream starts to trade in the European market on the Luxembourg exchange, our objective is to create similar liquidity profiles that we have in the US market. If you look at our overall debt and preferred equity structure here, we have 6 convertible notes. As I mentioned, we're reducing our reliance on these convertible notes as our primary mechanism to raise capital. And we'll start to see these start to mature and equitize over time. 4 of them are already in the money, 2 should be in the money by the time they mature. And so our objective is to reduce our reliance on convertible debt over time. And we'll increase our reliance here on our preferred equity, which you see, and we've, on a pro forma basis, include Stream in here, assuming a 350 million euro issuance. Our capital structure is quite robust. We have $93 billion in enterprise value, $77 billion in market cap, and $71 billion in Bitcoin asset value. Today, we have about $8.2 billion of convertible debt, which means they're about 1.1x levered on our convertible debt. And we have $7.1 billion of preferred debt. And we use the term amplification here because this isn't really leveraged as you would traditionally think. There is a coupon or a dividend payment, but these are perpetual. These are unique in that they never come due. We don't have to pay them back like we do a convertible note that might have a maturity of 4, 5, 6 years. These never come due, and as a result, we use the term amplification. This is a hybrid. This is not traditional debt, and it looks more like equity. And with this amplification, we're able to buy Bitcoin, pay dividends over time, and ultimately increase Bitcoin per share and Bitcoin yield to our shareholders. And you'll see here, there's about $731 million of pro forma annual dividend interest. Although that may sound like a large amount for some companies, for us, that's covered 97 years with our Bitcoin net asset value. This shows the $731 million of dividend interest payments. 570 million of that is from our 4 cumulative preferreds. And Stride, our most junior security, is non-cumulative and has fewer protections to the shareholder. And so $125 million of those dividends are non-cumulative and can be suspended at any time. And you'll see at the top of this structure is $35 million in interest on our debt. We do intend to be able to pay the dividends on these prefers. We don't really intend to use a non-cumulative feature, but this gives you a sense of the seniority in our interest expense. Another way to think of the $731 million, we get the question a lot, how much coverage do we have on the $731 million? How much at risk are we of not being able to pay the dividend and the interest? And we think it's pretty low. If you think about $731 million as a percentage of the last 12 months of total capital we've raised, it's less than 2%. If you look at the last 12 months of equity we've raised, it's less than 3%. And you look at it as the year-to-date 2025 operating income of the business is less than 7%. And if we have to, which we wouldn't, raise all of the dividends and interest for the year in one day, that's about 25% of our average daily trading volume. One important feature of our preferreds, because of the unique structure of our Bitcoin treasury business, is what we call ROC dividends, return of capital. The first four preferreds that we issued in the US have return of capital treatment, meaning as a company, we produce negative earnings and profits from a tax basis. And because it's negative earnings and profits, this is return of capital, which means that the dividends are tax deferred until you sell the underlying security. This is in contrast to qualified dividends, which have a tax rate of 20 to 35%, or interest income, what you might get from a bond or a money market or a bank account, which has 37 to 55% tax rates. When you add in the tax effect of both the federal taxes, state taxes, and local taxes. So we don't expect for the foreseeable future, 10 years or more, to produce positive ENP. In fact, we'll run our business to have negative ENP, which means that the ROC dividend guidance that we're providing will be for greater than 10 years out. And a US investor can expect that the ROC dividends will continue for the foreseeable future for all of our preferreds, including this new one, STREAM. If you're a European investor, we're working with the local regulatory bodies to see if we can get similar treatment in Europe, and it's something that we think is important and we'll pursue. Those ROC dividends really result in a scalable, tax-efficient fixed income generator. Our Bitcoin treasury model, which is unique to Strategy and unique to a company that capitalizes on Bitcoin, may be the most tax-efficient company in the world. What does that mean? We issue digital equity and digital credit like STREAM and like MSTR, and the proceeds from issuing that equity and credit is tax deferred. We can then purchase Bitcoin, which sits on our balance sheet. Any appreciation on that Bitcoin, as long as we don't sell our Bitcoin, which we don't intend to do, is tax deferred. And we're able to pay dividends, ROC dividends, on that credit, and that is also tax deferred. So we have a triple tax deferred model. So with that, I'm going to pass this over to our executive chairman, Michael Saylor, to tell you more about STREAM.
Thank you, Phong. I'm delighted to introduce STREAM to all of you today. We are in the business of creating digital credit. And so Strategy could be thought of as a digital credit factory. In essence, what we're doing is accumulating a large pool of digital capital, Bitcoin, and then we create credit instruments that create US dollar yield, like Stretch and Strife and Stride and Strike, and the credit investors get those ROC dividends, so they're tax deferred dividends. Now, it's a perpetual swap because our equity investors want BTC yield. So when we sell the credit, we invest it in Bitcoin and we generate more Bitcoin per share. That's what we call BTC yield. And as we hold that Bitcoin, it appreciates in value. And my long-term forecast over the next 20 years is approximately 30% a year ARR. So as it appreciates in value, it appreciates tax deferred. And the result is we generate tax deferred earnings for the equity investors while we're generating tax deferred dividends for the credit investors. That is the digital credit factory. Now, STREAM is the first digital credit instrument we've created for the European market. And whereas all of our other credit instruments generated USD yield, STREAM is going to generate Euro yield. So what is it? STRE is a Euro-denominated perpetual preferred security offering a fixed 10% dividend. Now that's very comparable to Strife, STRF, except instead of being $100 par value, it's 100 euros par value. STREAM will come out of the gate with a 5.6x BTC rating. That means for every 1 euro in STREAM we issue, we'll have 5.6 euros in collateral in the form of Bitcoin. It will be listed on the Luxembourg Stock Exchange. It will pay a quarterly cash dividend, similar to STRE, it does have protections. If we were to miss a dividend, there's a penalty clause and step up provisions in the dividend rate. And so we've worked to create, in essence, a Euro version of STRF for European investors. We've compared the two instruments here on slide 23. You can see we have about 1.2 billion of STRE outstanding. We're targeting 350 million euros of STRE. STRE's on the NASDAQ, STRE's on the Euro MTF. They're both fixed dividends. That means that they may trade above par. STRE is traded above par, so the price will fluctuate, causing the effective yield to fluctuate each day. They're both cumulative preferreds. They both have the escalating dividend protection feature. The effective yield of STRE right now is 9.2% because it trades above par. The duration of both instruments is perpetual. So if you're looking for a 10% dividend yield forever, perpetually, then STRE is a very interesting instrument. STRE is going to be senior to strike, senior to stride, senior to the common stock. It will be junior to our debt instruments, STRE and Stretch. Here you can see an illustrative pricing framework. With STRE at 109 right now, that gets you to a 920 basis point effective yield. You can see that that really looks like 300 basis points of spread. That's the US corporate high yield spread, and a 250 basis point incremental spread above the high yield rate in the US after accounting for the 10-year US swap rate. Now, if you were to apply the same spreads in the STRE instrument, well, the European 10-year swap rate is 260 basis points. The pan-European high yield spread is 280 basis points. So tacking on another 250 basis points of incremental spread implies that the parity value for STRE or the parity yield would be 7.9%. That means that if STRE were to trade at parity with STRE, it would be 127 euros versus a par value of 100 euros. If we discount it, and it's quite likely we will discount it for this deal because it's an IPO and because STRE is junior to STRE, then you can see that at par value, for example, that represents a 21% discount. That would be a 210 basis point premium over the parity value. Let's take another look at that. You can see the historic 10-year swap rates of the US dollar versus the euro. And of course, for the most part, over the past 3 years, the US swap rate has been higher than the European swap rate. It's 366 basis points versus 264 basis points. So there's about a 1% difference. And of course, if we look at the swaps curve all the way from a 2-year duration to a 50-year duration, the story is consistently the US dollar swaps curve is just higher than the European swaps curve. You can see the difference between European high yield and US high yield. And you see that the illustrative STRE spread over the swaps rate is 530 basis points. So we think that STRE looks very attractive, versus European high yield, and looks very attractive versus the European risk-free rate as well. Now, we've done some other comps. Here you can see the comparable ETFs in the European market. And you can see the effective yields for these ETFs are anywhere from 3.3 to 6.6%. They've got expense ratios of 39 basis points to 50 basis points. The US tax equivalent yield would be anywhere from 3.3 to 6.6. And of course, STRE, it's a 10% effective yield if it comes at par. And of course, there's no expenses. We don't charge expense ratios for any of our credit instruments. And if you're a US taxpayer with a 37% federal tax rate, the tax equivalent yield for STRE would be 15.9%. So it looks to be 2 times as good on an effective yield basis and perhaps 3 times as good on, or 3 to 4 times as good on a tax equivalent yield basis versus other ETFs in the marketplace. If we look at the broader credit indexes in Europe, the pan-European aggregate is $19.6 trillion with 9,800 members. The effective yield is 3.1%. The maturity is 8 years. And of course, you can see all these effective yields. They're 2 to 3% for the investment grade. For the high yield, they're 5.3 to 5.7%. Stream, of course, is going to be 10% effective yield and almost 16% US tax equivalent yield. So again, 2 to 3 or 2 to 4 times more yield, depending upon your tax situation. And the other thing worth pointing out is the maturity. You know, a lot of times the maturity on high yield instruments is shorter, like 4 years. A lot of instruments are callable or refinanceable. Stream isn't callable by us, so it's a 10.3 year effective maturity. So if you're a long duration credit investor, this is a 10% effective yield for, you know, for the Macaulay duration of 10.3 years, but it's pretty compelling. We'll take a look at hybrids in the European market. You can see a bunch of B-rated hybrids. The liquidity of these instruments is €1 million a day. We expect Stream to be much more liquid. If it has the same liquidity profile as Strife, it'll be 5 times more liquid. The duration of those instruments is 3 to 5 years. Stream will be 10. The effective yield of those instruments is a 5 or a 6 handle for the most part. Stream will be 10. The tax equivalent yield of Stream, again, 15.9% for a US equivalent taxpayer. So we think that Stream represents a pretty compelling credit offering in the European high yield markets. And, you know, it's so compelling on a duration, effective yield, and tax equivalent basis. I mean, the question really becomes, you know, what's the catch? What's the risk? Well, here you've got one screen. You can see that Stream is on a tax equivalent basis is twice as good as the next best thing, private credit, you know, and you know, money markets in Europe are 1.5%, and so Stream is going to be the digital credit instrument in Europe. And it should actually cause people to reset their expectations about what is a decent yield for a credit instrument. In order to help you understand or assess the risk, we've included our credit model here in the presentation. The thing about digital credit is you can do a digital credit risk assessment in real time. If you go to our website, strategy.com, there's a credit tab. And in that credit tab, we have our capital structure. And every 15 seconds, we feed in the current BTC price. We feed in the rolling BTC volatility. And we give you the ability to put in your own forecast for the next 10 years of volatility and your own forecast for the next 10 years of BTC ARR. How will it perform? So if we take a standard statistical model and we plug in a price of volatility forecast and an ARR forecast, we can arrive at a risk that you will be under collateralized at the end of the duration. And so we call that BTC risk. You can see here, if you assume Bitcoin's going up 0% forever, that's 0% BTC ARR, you're a skeptic. And if you think that Bitcoin's going to remain volatile, 44% vol is the rolling yearly. It's a rolling 12-month volatility, or looking back, the average volatility of the last 12 months of Bitcoin. And you plug in the current price, about 110,000. Well, you can see that the risk for these credit instruments in the preferred stack range from 26 to 35% that you'll be under collateralized at the end of the duration. You can extract a credit spread that offsets that risk, a fair credit spread. That would be our BTC credit number. And you can see that fair credit spread is anywhere from 270 basis points to 397 basis points. Now we have plugged in the market credit spread, and you can see the spread premium here. And of course, even if you're a skeptic, there's a very large spread premium over the market credit spread for these instruments. So that's the first interesting observation. Now, what happens if I assume that Bitcoin will go up 10% a year? If you think Bitcoin is going to perform like the S&P index, well, you can see this entire credit model shifts dramatically, and now the risk fall into the 8 to 12% level. The credit spreads on the preferred instruments fall to 77 to 126 basis points, and of course the market credit spreads haven't changed, but the spread premium gets to be pretty large. And of course, the final slide is what happens if Bitcoin appreciates at 10% a year and the volatility continues on its downward trajectory? About 5 years ago, Bitcoin vol was about 85%, and it fell from 85 to 75 to 65 to 55 to 45 over the past 5 years. So as the asset class matures and the volatility decreases, you could imagine that on average over the next decade, it would be a 30 vol and a 10% ARR. If you have that outlook, what you can see is that the risk becomes quite minor, and all of these instruments look investment grade, right? All the risk on the bonds go to effectively de minimis, and then the risk on the preferreds go to anywhere from 4 to 13 basis point fair credit spreads. So the market right now misunderstands the actual credit risk involved with these instruments, and they're fairly skeptical on Bitcoin as collateral. So that means that the spread premiums are quite wide. But if you are a credit investor and if you have a positive outlook toward Bitcoin, you can see there's an opportunity here, because as Bitcoin appreciates in price, the BTC ratings will increase. As the Bitcoin volatility decreases, the BTC risk will decrease. And of course, as Bitcoin performs, then this asset class matures. So these are all very credit positive things for the asset class and digital credit in general. So with that, we've got a few more slides in the deck. They go over the definition of all of our KPIs, and they explain all of the metrics used in the presentation. So feel free to peruse that if you like. I'll just summarize with the big picture, which is we think that Stream is a pretty compelling digital credit instrument. It's the first digital credit we've offered in the European market. And you can see here, because we're raising capital in perpetuity and investing it in Bitcoin in perpetuity, we can pay higher effective yields, which are to the benefit of the credit investor. And we can provide those yields in a ROC dividend, which is to the benefit of the credit investor as well. So I appreciate your time and attention to this today. And we'll look forward to answering any questions you might have as you look further at our offering.